Hello and welcome to another edition of Market Briefing. I'm Martin Bakkerdax, European business editor here at the IB Times UK. Well, we're looking at a bit of a rebound for European shares this morning. Yesterday, of course, one of the steepest declines across the board in about 3 months, particularly here in the United Kingdom, but also in Europe as well, following along from the tumble of stocks in the United States. Reasons to be optimistic this morning from an economic point of view, however. A private reading of economic activity around the Eurozone shows levels in the services sector and indeed at a composite level at a 10-month high. That's very encouraging indeed. However, that cleave between activity in Germany, which had its biggest monthly advance in about 3 years, to that of France, where activity fell to the lowest level in 4 years, is very troubling indeed for investors, and that is mitigating some of the gains. Another factor in terms of the cautious tone that investors have today is the consideration for European retail sales for the month of December. They fell 3.4% year on year. So clearly the pinching and the squeezing that we're seeing at the austerity level, indeed at the government level, has already trickled down to the European consumer. It's probably no surprise when you consider you're looking at 11.7% unemployment across the board, and that number gets as high as 25% when you get to economies like Spain and Greece. Here in the United Kingdom, we saw a modest improvement in the services sector activity for the month of January as measured by the economics data provider Market. It grew to 51.5, a big jump from the month of December. It probably points to modest growth for the first quarter of this year, at least of about 0.1%, but there's a lot of headwinds to that, particularly given the snowstorms in the month of January, which are going to impede at the very least retail sales and perhaps the manufacturing sector as well. We'll keep an eye on that, of course, in the coming days. Deep day in terms of interest for the banks again as well. UBS reported quarterly earnings early this morning. They took a 1.89 billion Swiss franc hit, largely because of, well, not only restructuring costs, they're going to get around 10,000 bankers out the door in the next 3 years as they trim down their global investment banking activities, but also because of that record $1.5 billion LIBOR fine they had to pay in the latter part of last year. Barclays said it had to increase the money it's going to set aside to compensate PPI and small businesses who were missold derivatives and other insurance products over the past years by about $1 billion. The total compensation is probably going to be about 3.5 billion sterling, and it may indeed get higher when we understand exactly the scale of some of those mis-selling scandals. BP as well gave us some quarterly earnings, which are slightly better than expected, with profits coming in around $4 billion US, but they still face an enormous amount of litigation risk. And to date, actually I shouldn't say to date, I say to the end of December, they've already had to set aside $42.42 billion US to compensate, well, pretty much everybody involved in that fatal Gulf of Mexico oil spill in 2010. We'll keep an eye on all those stories and, of course, many more. So do come and visit us on the IB Times economy page. We'll see you tomorrow.